What's going on, everybody? This is Cullen Gandy coming at you with another video about mortgage finance, personal finance, and this particular video is for you guys who want to be mortgage loan originators specifically because this is going to cover one of the most important topics, especially when you're taking the MLO SAFE test, which is to say we are going to be covering a short synopsis of what all goes into the Truth in Lending Act, or TILA. Now, TILA is a really huge, sort of all-encompassing act within the mortgage industry, and is something you're going to be running into day after day as a mortgage loan originator. So there's not really a way that I can sort of compress everything down to a 10 or even a 20-minute video to get into the nuances of how it interacts with the mortgage industry, which is very highly regulated, as well as the economy in general. But I can sort of give you the specific reasons for why TILA is important to you as a loan originator, or on a larger scale as a lender. Truth in Lending Act, or Regulation Z, is part of a larger structure in the Consumer Credit Protection Act that came about on the 1st of July 1969. What you really need to know about TILA is that it was specifically created to help the consumer interact with especially non-depository lending institutions, like if you're a mortgage broker or a mortgage lender, to help make sure that the person lending the money is being really upfront with all of the associated costs and terms of a loan, to make sure that all of those people are well informed by the lenders themselves as to what the terms of the loan are that they're advertising. And if they don't know, we have to make sure that we give them the disclosures up front and correctly in order to make sure that we're in compliance with the government. This is one of the major directives of the CFPB, or the Consumer Financial Protection Bureau. After the big mortgage-backed securities meltdown of 2008, 2007, it became really apparent that something was broken in the secondary market of the mortgage industry, and it kind of spilled over even into the first market, which is to say the mortgage lending and the people borrowing the mortgages as well. Nobody was really looking too great after that event. We had irresponsible buyers taking on loans that perhaps that they didn't understand, or maybe they did understand, that they couldn't afford. And we had lenders that were all too happy to give them those loans if it meant we got big fat, commission checks in our pocket at the end of the day. This was also a really important change for loan originators as well during this period, because during that particular period in time, loan originators actually could get compensated on what's called a yield spread premium, which means that we could sort of try to steer borrowers into a loan that might not have been as good of a fit, but got a much better profit margin on our end. This kind of levels the playing field even from back in the early 70s, late 60s, all the way until now, and is constantly being revised and re-edited to make sure that you, the consumer, is protected against sometimes yourself or predatory practices by lenders. In fact, the main directive of TILA is simply to make sure that the consumer is informed of all of the terms of their prospective credit, or what they're about to take on, by giving them disclosures up front. Specifically, this deals with three prospective parts of this, which is to say the amount of credit, the APR, and how we advertise these products and package them. Now, there are a number of different TILA-related disclosures that we are going to be providing borrowers, or if you're a borrower, you're going to be receiving these. We'll go over each of those in a moment, but one important thing for the test that you're going to need to know if you're an MLO or a prospective MLO is that most of these disclosures you're going to be holding on to for a period of 2 years in your records, unless that disclosure is the LE, or what's called a loan estimate document, in which case you're going to have to keep that for 3 years, or if it's the closing disclosure, which is the the disclosure that you get at closing, pretty unique name. You're going to need to hold on to those for 5 years for your records. You're going to have to do that because should questions down the line come up about your compliance on any loan that you write, you can show your regulator that you were on the up and up the whole time. One really important piece of information when you're taking the test as it relates to TILA is that TILA is mainly geared toward, in fact, it's entirely geared towards residential properties that go from 1 to 4 units. That is to say, you're going to have single-family homes, duplexes, triplexes, or fourplexes or quadruplexes. Also, it's important to note that these are going to be concerned with loans that are in installments of more than 4. If you have a loan that you have to pay more than 4 times over a given period, TILA is going to be applying to these types of loans. What they're not going to be applying to is any commercial loans, any business-related loans, or any non-residential related loans in general. You know, if something's not secured by real estate that's residential, chances are it's not going to be covered by TILA. For a lot of these disclosures that we're going to be discussing, they're going to have to do with when you have to provide them to the borrower and which days actually count as days that go towards this count. For example, most of the disclosures in TILA, in fact all the disclosures, are going to have to take place on business days. However, in the mortgage industry, it's a little bit different than other kinds of business. Usually for business, the business week is from Monday to Friday and doesn't include Saturday or Sunday. However, in the mortgage industry, all business days include Monday through Saturday, but not Sundays or federal holidays. For example, if you received a loan application from somebody on a Friday and you need to provide them a loan estimate document by 3 business days, then you're going to want to know that you're going to have to do it by Saturday, not Sunday, Monday, and then Tuesday is the last day that you can be sending them the loan estimate before you are out of compliance with TILA. However, there is a special case with the loan estimate, or the LE, because if the creditor's office happens to be open on a day that falls on a non-traditional business day, then that also counts as a business day, and so it would go towards the count for that 3-day limit on a loan estimate. One of the really important things that has to do with TILA is how we advertise to our borrowers, right? How we represent our loans and our products to our borrowers so that they understand them and so that we aren't misleading them intentionally or unintentionally. One really important check and balance for this has to do with triggering words or trigger terms. Trigger terms are determined by the Federal Trade Commission, or the FTC, and they go into the things that we cannot say in an advertisement without accompanying the entire litany or list of other accompanying and mitigating factors that go along with any numbers that we might be advertising to you. That means just that if we give you a term that falls under one of these triggering terms, we have to clarify it in the context of the entire scope of the deal. I'll give you an example. Here's a list of things that are going to be triggering, right? If you list the amount of a down payment as expressed in a percent, if you list a monthly payment obligation out of context, if you list the number of installments or the number of payments that you're going to have to make, if you list that there are a certain amount of years on a loan available, or if there's a certain amount of payments that you can make, and if you list that there's a certain finance charge and you list the number down as an amount, these are all going to be considered triggering situations or trigger terms. So if you list any of those terms, you have to list all of them in context. So you have to list the amount of the down payment, the terms around the payment and how you can qualify for it, the annual percentage rate, or what the percentage rate is with certain types of origination costs and closing costs, as well as if that APR can change over a given period depending on how the terms can change, for example, in an adjustable rate mortgage. As far as advertising is concerned, the vaguer you are, the better it's going to be. You're going to have a better time doing it. Instead of saying down payments of 9%, you can say low down payment percentages, or favorable terms if you qualify, right? So you're going to have a lot of conditional statements based on some pretty standard clauses, right? Got to qualify for it. If you qualify for it, it's probably going to be pretty good. One thing you're not going to say is like, oh, we can give you a 2.5% rate. Guaranteed, right? Guaranteed is a word you're going to want to stay away from in this business. Now I'm going to go over a list of disclosures that are going to be associated with TILA that you probably are going to interact with in your life. First up, probably going to be really familiar with the loan estimate document. This is the document that is going to list off the terms of the loan, such as the loan balance amount, the rate, the term of the loan, and the APR, essentially all of the fees and any of the escrow balances and things, as well as the cash to close and all that good stuff. If you want to learn more about the loan estimate document, I'm going to put a link in the video right here that you can click on, as well as in the description, because I kind of go into more detail about how we calculate that. Next, we have the closing disclosure, and the closing disclosure needs to be provided to the borrower at least 3 days prior to the closing. Otherwise, you're not going to be in compliance with TILA. For that to be also true for the loan estimate, you need to provide that within 3 days of the application, and the last loan estimate that you send to a borrower has to be 4 days prior to the closing, because obviously you need to do the last closing disclosure 3 days prior to the closing. You're also going to have the ARM disclosure, the adjustable rate mortgage disclosure, and that's going to have, like a normal loan estimate, the details of your specific ARM and how it functions. You're also going to have something called the CHARM booklet, or the Consumer Handbook on Adjustable Rate Mortgages. This is for you guys that are going to be doing adjustable rate mortgages. Obviously, this is a standard go-to for those kinds of loans, because we want to apprise people of how exactly adjustable rate mortgages function, because they can be kind of tricky even when you're calculating them as a lender or loan originator. So imagine how complicated it can get for the borrower trying to figure out how much they're going to pay after a certain amount of years when an index changes. Also, there's going to be a more specific disclosure that has to do with if you're taking out what's called a home equity line of credit, or a HELOC. And that disclosure is called when your home is on the line. This sort of gives the borrower a sense of what their obligations are when it comes to the revolving line of credit they're attaching their home to, and what the terms are of being in compliance and out of compliance with that, because that's a very, very sort of different kind of transaction than just your normal home equity loan or your first position, mortgage. Then you're going to have things like the notice of right of rescission, and this is going to be specifically for what's called a refinance transaction. And this is the only one that has a right of rescission attached to it, other than some other non-traditional type loans. This is going to be the disclosure that tells the borrower that they have 3 business days after closing and signing and doing everything at the settlement to back out of the loan, to rescind their participation in the loan before they are obligated for the terms of that loan. And one really important thing about the right to rescind, or the rescission disclosures, is that you have to provide 2 copies to each of the applicants. That's to say, each of the persons that's going to be involved and listed on the loan need to be provided 2 copies of this disclosure. 3 types of loans that you're going to want to associate with this right to rescind are going to be the regular home equity loans, that is to say, refinances on your primary home or investment home, as well as any HELOCs, or home equity lines of credit, or home improvement loans and things of that nature. But if it's a purchase transaction and you have another party that's a seller or a buyer that's sort of involved in the transaction, can't really use the right to rescind, because that's not really fair. In a refinance transaction, the only 2 parties are the lender and the person who owns the property. So it's a little bit more wiggle room there if they get kind of nervous at the end. Another really important disclosure that you're going to have to know from TILA is the transfer of ownership disclosure. And that's going to be, the transfer of ownership of a title on a property from one party to the next. And that has to be sent out before 30 days after the transaction has been settled. The information on the disclosure is just going to be the name of the mortgagee, the telephone number, and the address, so that if there are any problems come up, or if a title search comes up, they know who to get in touch with, because you're the new mortgagee. Now, another subject that TILA is going to discuss, I'm going to get in a little bit more depth in another video about, but it does cover how PMI comes about. That's HOEPA, or the Homeowners Protection Act, as well as high cost loans, and how they're regulated, which is called the Homeowner Equity Protection Act. And I'm going to go over both of those just generally right here. When you're looking at loans that deal with HOEPA, the Homeowners Protection Act, it's really important to note that, PMI is generally what we're going to be concerned with, which is private mortgage insurance, and not MIP, which is very, very close, which is called the mortgage insurance premium, which has to do more with the FHA loans that you have to sort of pay an upfront mortgage insurance premium, which is actually called an UFMIP. That's not really what that talks about. But the PMI is really important because that really does affect your day-to-day and month-to-month payment on these loans, especially if you're higher than an 80% loan-to-value ratio. Now, loans associated with HOEPA are going to have all sorts of stipulations. You're going to have no negative amortization. That is to say, you have to be able to go all the way to the end of the loan and be paid off. You're not going to have any balloon payments. You're going to have to make sure that the terms of the loan are equitable and that we can establish the ability to pay, which has to do a lot with my other video when I was talking about what a qualified mortgage is. Finally, it gives you sort of a limit on how long it takes before you can refinance a property. Because in the past, loan officers such as myself would try to churn out more refinances in a given period of time to sort of milk folks for the fees. And so that's not a very, that's sort of a morally dubious practice. They sort of nixed that with the Homeowners Protection Act. One other really important section in TILA is going to be the Homeowner Equity Protection Act, or HOEPA. And again, I'll do another video on this, just sort of going into depth about what this covers and how it covers it. HOEPA is going to deal with unfair practices or deceptive practices, especially if they have anything to do with high cost or highly priced loans. And it's really important to distinguish between Section 32 and Section 35 because they're not the same. Priced loans aren't necessarily going to be high cost loans and vice versa. High cost loans have to do with if the annual percentage rate, or the APR, that is to say all of the information that goes into the rate after you calculate certain types of fees and costs, that's going to be on the high cost end, as opposed to higher price loans, which go to the offering of the individual rate on offer based on, if you're on the lower end of the spectrum, some people might try to take advantage of you by spiking up the points more than they ought to. So HOEPA is going to cover all purchase and refinanced transactions. It's also going to cover closed-end home equity loans as well as home equity lines of credit. However, HOEPA does not concern itself with what's called a HECM, or a reverse mortgage, a home equity conversion mortgage as they call it. You're also not going to be dealing with any loans that are like construction loans or any loans that are guaranteed by the FHA. On a high cost loan, you're going to want to note that there's probably not going to be any prepayment penalties, and there's certain parameters for how that is calculated, how a high cost loan should be calculated. And if it falls within those parameters, obviously we're going to make sure that there are no prepayment penalties, because we don't want you to be punished for meeting your obligations even if they are a little sooner than we expected, right? You're also going to be considered a high cost loan if the points and fees exceed 5% to the LO or to the institution in general in origination. So look out for that, because once that happens, all of these HOEPA ideas kick into action. Moving on to what's called Section 35 of TILA, or the high price loans, you're going to be getting into a different category of loan. This is where you're going to find like jumbo loans, are loans that are above the conventional loan limit in your county. So look out for those, because those sometimes they change on an annual basis depending on if there's inflation or where the real estate market is currently. You're also going to watch out for high price loans whenever it comes to things called subordinate liens on the property. That is, loans that are on a property that don't possess that first position, that main first home mortgage that you're going to be paying off and that you're going to be making a priority to pay off, because that is the first loan that, if you go into foreclosure, is going to be considered when there is a disbursement after the foreclosure. So that's going to be the first one paid off. Higher price loans are any loans where the APR, the annual percentage rate, exceeds the annual prime offering rate by 1.5% or more. For a higher price loan, you're going to need a 5-year impound of escrow on these loans to be accounted for, just to make sure that things are safe and that there's a buffer that we can provide for that requirement. You can sort of get out of this 5-year hold on an escrow impound for taxes and insurance if the loan to value after 5 years is lower than 80%. That is to say, if the loan represents less than 80% of the value in the equity in your home, you can go ahead and get rid of that requirement after 5 years. And for any of these loans, we're going to have to make sure that you can refinance, but only after a year, and only if it is beneficial to the borrower. This is again talking about the net tangible benefit, which is a term you're going to be getting used to in the mortgage industry. This is establishing that the borrower has a reason to get this refinance, that it's benefiting them in a way that is palpable, whether that's saving money on the loan by getting a lower rate, or being able to pull cash out to make other investments from their equity in their home. Earlier on, I alluded to loan officer compensation. Loan officer compensation is actually a really, really important part of this conversation, because loan officer compensation is actually one of the factors that led to a sort of conflict in interest when it comes to our sort of fiduciary-ish responsibility to the borrowers. That is to say that it should be incumbent on us, it should be our responsibility to act in the borrower's best interest. And it is now that the CFPB has sort of re-geared the mortgage industry towards that. But loan officer compensation as a result of TILA now means that we can no longer be compensated on different levels depending on different products. It has to always be set and standard from the beginning of the transaction and cannot move after it's been disclosed. As a result of this, the yield spread premium, or the YSP that I was talking about earlier on when we were talking about the financial crisis, that was completely eliminated during this phase of TILA, and made sure that we are just getting compensated on a set rate so that we're not incentivized, or we're not given a sort of conflict of interest when it comes to closing a deal for our borrowers. So guys, I really hope you enjoyed this sort of brief-ish synopsis about what goes into the Truth in Lending Act, or TILA. I guarantee you probably get about 20 questions that are sort of directly or tangentially or in some way related to TILA during the course of your SAFE NMLS mortgage loan originator test. So please go over this, make sure that you have a generally good understanding about how TILA works, and go into each of the details about what you have to do as far as when you're disclosing, when you're advertising, and when you are making these deals, and how it sort of interacts with TILA. Because this is the biggest, baddest regulation on the block, and you're going to want to stay in compliance, folks. That being said, if you like this video and other educational content like this, please go ahead and consider leaving me that like. Go ahead and subscribe for me, and as always, I want to notify you, so hit that notification bell as well. And I will see you in the next one, hopefully a little bit richer and a little bit happier. Peace, guys.